Alright, let's talk about something almost everyone has dealt with but barely thinks about. You open your banking app, you see your paycheck come in, bills go out, and whatever is left just kind of sits there. Maybe it's in a checking account. Maybe a savings account earning almost nothing. And every month you feel like you're doing fine, but somehow your money never seems to grow. You're not broke, but you're not getting ahead either. If that feels familiar, you're not bad with money. You're just probably using the wrong place to store it. Most people open their first bank account when they're young. A parent takes them to a big bank because it's on every corner, has a fancy building, and feels official. You stick with that bank for years out of habit. Same debit card. Same app. Same low interest. Same random fees. And no one ever explains that where you keep your money matters just as much as how much you make. That's the real problem most people face, and today we're breaking it down in the simplest way possible. Big banks versus credit unions, and where your money actually grows more. Let's start with big banks, because that's what most people are using right now. Big banks are massive companies. They have thousands of branches, expensive buildings, big advertising budgets, and executives making millions of dollars a year. All of that costs money, and a lot of that money comes from customers. That usually shows up as low interest on savings, higher fees, and stricter rules. You might earn a few cents a month in interest while paying monthly maintenance fees, overdraft fees, or ATM fees without even noticing. Think about a typical savings account at a big bank. You put in $1,000 and let it sit for a year. At the end of that year, you might earn enough interest to buy a cup of coffee, maybe not even that. Meanwhile, inflation is quietly making that money worth less over time. So even though your balance number goes up slightly, your purchasing power goes down. That's one of the biggest hidden money problems people don't realize they're facing. Now let's talk about credit unions, because they work very differently. A credit union is not owned by investors or shareholders. It's owned by its members, which means people like you who have accounts there. Because of that, the goal isn't to squeeze as much profit as possible out of customers. The goal is to serve members. That simple difference changes almost everything. When a credit union makes money, it usually goes back to members in the form of higher savings rates, lower loan rates, and fewer fees. Instead of funding massive ad campaigns or luxury offices, they focus on everyday banking benefits. That's why credit unions often offer savings accounts that earn more interest and checking accounts that charge fewer fees. Let's make this real with a simple example. Imagine two people who earn the same income and save the same amount every month. One keeps their money at a big bank earning almost no interest. The other uses a credit union with a higher savings rate and lower fees. Over a few years, the difference doesn't look dramatic at first, but slowly it adds up. The credit union member keeps more of their own money simply because less of it is leaking out through fees and low interest. Another big difference shows up with loans. Think about car loans, personal loans, or even credit cards. Big banks often charge higher interest rates because they're focused on maximizing profit. Credit unions usually offer lower rates because they're focused on helping members borrow affordably. That means less money going toward interest and more money staying in your pocket. Picture buying a car. At a big bank, you might get approved quickly, but at a higher interest rate. At a credit union, you might get a lower rate, which could save you hundreds or even thousands of dollars over the life of the loan. That's money you can save, invest, or spend on things that actually matter to you. Now, this doesn't mean big banks are evil or useless. They can be convenient, especially if you travel a lot or need access to many branches. Their apps are often polished, and they offer a wide range of services. But convenience often comes at a cost, and most people never stop to ask if that cost is worth it. One common mistake people make is assuming all banks are basically the same. They're not. The rules, fees, and benefits vary a lot. Another mistake is staying loyal to a bank that hasn't been loyal to them. If your bank charges fees, pays almost no interest, and doesn't help you grow financially, it's okay to question that relationship. Here's something important to understand. You don't have to choose one or the other forever. Many people use both. You might keep a checking account at a big bank for convenience and use a credit union for savings and loans. That way, you get easy access to your money while still letting it grow faster in the right places. If you're watching this and thinking, I don't even know where to start, here's a simple action you can take. Look at your current accounts and ask two questions. How much interest am I earning, and how much am I paying in fees? If the answer is, almost nothing and, more than I realized, that's your sign to explore other options. You can search for local credit unions in your area, check their savings rates, and see what fees they charge. Most credit unions make it easy to join, and many are open to anyone who lives or works nearby. You don't have to close your big bank account right away. You can start small by opening a savings account and testing it out. The big takeaway here is simple. Your money should work for you, not just sit there. Big banks often focus on their growth. Credit unions are designed to focus on yours. By choosing where you keep your money more intentionally, you can stop losing ground and start building it, even without earning more or saving more. So if you want your money to grow more without doing anything risky or complicated, start by putting it in a place that actually helps you. Sometimes the smartest money move isn't about investing or budgeting harder. It's just choosing a better home for the dollars you already have.